Hello everyone, and welcome to FinWiser Advisory. In this course, we will be talking about financial modeling, DCF and comparable valuation. This course is divided into 16 modules. We are building a financial model on Tesla Motors. In Module 14, we will cover ratio analysis. In this module, we will understand how to calculate various ratios. We will be using Microsoft Excel. In this template, there are two sheets named as Ratio 1 through Ratio 2, which, step by step, run the user on how to calculate ratios in the model. Historical income statement, balance sheet, and cash flow created in the previous modules are available in this as well. Once the user completes a module, the final outcome of that is available to be used in the next module. Now, let's get started. In a discounted cash flow valuation model, ratio analysis can be an essential complement to assess the health, efficiency, and sustainability of the business being valued. While DCF focuses on cash flow forecasts and discounting them to the present, ratio analysis provides insights into the company's financial performance and stability over time. Price-based valuation ratios are financial metrics used to evaluate a company's stock price relative to its financial performance or position. These ratios help investors assess whether a stock is overvalued, undervalued, or fairly priced in the market. They compare the current market price of a company's shares with key financial figures such as earnings, book value, sales, or cash flows. Common price-based valuation ratios. 1. Price-to-earnings ratio or P/E ratio indicates how much investors are willing to pay for each dollar of earnings and is calculated as market price per share by earnings per share. 2. Price-to-cash flow ratio or P/CF ratio evaluates how much investors are willing to pay for the company's cash-generating ability is calculated as cash flow per share by market price per share. 3. Price-to-book ratio or P/B ratio measures the market's valuation of a company relative to its book value and is calculated as market price per share by book value per share. 4. Price-to-sales ratio or P/S ratio assesses the value of a company's stock compared to its sales revenue and is calculated as market price per share by revenue per share. EV-based valuation ratios are financial metrics that compare a company's enterprise value (EV) to various financial performance indicators. Enterprise value represents the total valuation of a company, combining its market capitalization, debt, and minority interest while subtracting cash and cash equivalents. These ratios help assess a company's overall value relative to its revenues, earnings, or profitability metrics, providing insights for investors and analysts. Common EV-based valuation ratios. 1. EV to revenue ratio measures how much investors are willing to pay for each unit of revenue generated by the company is calculated as enterprise value by total revenue. 2. EV to EBITDA evaluates the valuation of a company relative to its operating cash flow, offering a clearer picture of operating performance by excluding the impact of capital structure, taxes, and non-cash expenses. This is calculated as enterprise value by EBITDA. 3. EV to EBIT compares a company's overall valuation to its operating profit, focusing on the core profitability of the business before considering interest expenses and taxes. This is calculated as enterprise value by EBIT. Per-share metrics for valuation help assess a company's financial health and performance on a per-share basis, offering investors a clear and comparable view of its value. These metrics are particularly useful for analyzing dividend payouts, cash generation capabilities, and shareholder returns. 1. Dividend yield is calculated as dividend per share by market price per share and indicates the return an investor earns through dividends relative to the stock's market price. 2. operating cash flow per share calculated as operating cash flow by total number of shares and measures the cash generated from a company's core operations on a per share basis. 3. A free cash flow per share indicates the cash available to the company for distribution to shareholders or reinvestment after covering its operational and capital expenditure needs. This is calculated as free cash flow by total number of shares, where free cash flow is operating cash flow less capital expenditure. DuPont analysis, also known as the DuPont identity or DuPont model, is a financial performance framework used to break down a company's return on equity (ROE) into its key components. This detailed decomposition helps analysts and investors understand the underlying factors driving profitability, operational efficiency, and leverage. The traditional DuPont formula is expressed as ROE equals PAT margin times return on assets times financial leverage, where PAT margin equals net profit by revenue. Return on asset equals total revenue by average assets. Financial leverage equals average assets by average equity. Gearing ratios measure a company's financial leverage, reflecting the proportion of its financing that comes from debt relative to equity or other financial metrics. These ratios help assess the risk associated with a company's capital structure and its ability to meet long-term obligations. 1. Gross gearing compares debt to the total capital employed, that is, debt and equity, and is calculated as total debt by equity plus debt. 2. Net gearing compares debt to the total capital employed, that is, debt and equity, and is calculated as net debt by equity plus net debt. 3. Net debt by total equity considers the company's cash position, reflecting the net debt relative to equity, and is calculated as net debt by total equity. Liquidity ratios measure a company's ability to meet its short-term obligations using its current or liquid assets. These ratios are essential for assessing a firm's financial health and short-term solvency, helping stakeholders determine if the company can pay off its immediate liabilities. 1. Cash ratio measures the company's ability to pay off current liabilities with only its most liquid assets, that is, cash and equivalents, and is calculated as cash and cash equivalent by current liability. 2. Current ratio indicates the company's ability to cover its short-term liabilities with all its current assets and is calculated as current asset by current liability. 3. Quick ratio evaluates a company's ability to meet short-term liabilities using its most liquid assets, excluding inventory, and is calculated as current asset minus inventory by current liability. Leverage metrics is used to evaluate a company's ability to service its debt obligations using its earnings. They measure the level of debt relative to the company's EBITDA, offering insights into financial stability and risk. 1. Gross debt by EBITDA compares the company's total debt to its EBITDA. This is calculated as gross debt by EBITDA. 2. Net debt by EBITDA compares the company's net debt to its EBITDA. This is calculated as net debt by EBITDA, where net debt equals total debt less cash and cash equivalents. These ratios evaluate a company's investment in fixed assets relative to its revenue generation and depreciation expenses. They are useful for assessing growth strategies, asset management, and sustainability of operations. Working capital ratios assess a company's operational efficiency and short-term financial health by analyzing its ability to manage current assets and liabilities. These ratios focus on the liquidity and turnover of components like inventory, receivables, and payables. 1. Account receivable turnover ratio measures the efficiency of collecting receivables from customers and is calculated as number of days in a year by accounts receivable days. 2. Inventory turnover ratio measures how quickly inventory is sold and replaced during the year and is calculated as number of days in a year by inventory days. 3. Accounts payable turnover ratio measures the efficiency of paying creditor and is calculated as number of days in a year by account payable days. Enterprise value or EV is the measure of a company's total value. It looks at the entire market value rather than just the equity value, so all ownership interests and asset claims from both debt and equity are included. EV can be thought of as the effective cost of buying a company or the theoretical price of a target company. EV is calculated as market value of equity, add total debt, add minority interest, add preference share, and less cash and cash equivalents. That's all for now. See you in the next module. Have a wonderful day.